Viewers, now shifting our focus to another top story that we are tracking at this point of time. RBI Governor Shakti Kanta thus has briefed the media over the monetary policy. Let's now listen in.
Of 21st century India. It stands out for its committee approach to decision making, transparency of policy making process and communication, accountability hinging upon quantitatively defined inflation target, and operational independence. Over the years, the framework has matured across various interest rate cycles and monetary policy stances. When I look back, I can say with confidence that the flexible inflation targeting has served us well over the years and has proved its mettle. It brought about an era of price stability in the pre-COVID-19 period, with inflation averaging around the target rate of 4%. Thereafter, despite continuing global turmoil from multiple sources in the last 4 years or so, the flexibility embedded in the flexible inflation targeting framework has helped us to effectively address these unprecedented challenges while supporting growth. Monetary policy in India was able to respond to the economic slowdown decisively and swiftly in the wake of the COVID-19 pandemic, and again preemptively during the buildup of inflationary pressures after the war began in Ukraine in early 2022. The prevailing well-balanced growth inflation dynamics is indeed a testimony to the success of this monetary policy framework. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on, and this time, as you would be aware, this time we have 3 new external members in the MPC. The Monetary Policy Committee with 3 new external members met on 7th, 8th and 9th October. And after assessing the evolving macroeconomic and financial conditions and the outlook, the MPC decided by a majority of 5 out of 6 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate and the bank rate, they stand at 6.75%. Further, the MPC decided unanimously to change the stance, that is the stance of the monetary policy, to neutral, and also decided to, let me read it again, the MPC decided unanimously to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC noted that currently the macroeconomic parameters of inflation and growth are well balanced. Headline inflation is on a downward trajectory, though its pace has been slow and uneven. Going forward, the moderation in headline inflation is expected to reverse in September and likely to remain elevated in the near term due to adverse base effects, among other factors. Food inflation pressures could see some easing later in the financial year on the back of strong kharif sowing, adequate buffer stocks and good soil moisture conditions, which are conducive for rabi sowing. Adverse weather events continue to pose contingent risks to food inflation. Core inflation, on the other hand, appears to have bottomed out. Fuel component of the CPI remains in contraction. Domestic growth has sustained its momentum with private consumption and investment growing in tandem. Resilient growth gives us the space to focus on inflation so as to enable its durable descent to the 4% target. In these circumstances, the MPC decided to remain watchful of the evolving outlook in the coming months. Keeping in view the prevailing inflation and growth conditions and the outlook, the MPC considered it appropriate to change the stance to neutral and to remain, I repeat, and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth. I would now turn to an assessment of the growth and inflation situation. First, let me talk in brief about the global growth conditions. The global economy has remained resilient since the last meeting of the MPC in August. Although downside risks from increasingly intense geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and elevated public debt continue to play out. Manufacturing is showing signs of slowdown while services activity is holding up. World trade is exhibiting improvement. Inflation is softening, supported by lower energy prices. Growing divergence in inflation growth dynamics across countries has resulted in varying monetary policy responses. Let me now turn to domestic growth. Real GDP grew by 6.7% in the first quarter of this financial year, that is 24-25. And this was led by a revival in private consumption and improvement in investment. The share of investment in GDP reached its highest level since 2012-13. Government expenditure, on the other hand, contracted during the first quarter. On the supply side, gross value added, that is GVA, expanded by 6.8%, surpassing the GDP growth, aided by strong industrial and services sector activities. High-frequency indicators available so far suggest that domestic economic activity continues to be steady. The main components from the supply side, that is agriculture, manufacturing, and services, they remain resilient. Agricultural growth has been supported by above normal southwest monsoon rainfall and better kharif sowing. Higher reservoir levels with good moisture conditions of soil augur well for the ensuing Rabi crop. Manufacturing activity is gaining on the back of improving domestic demand, lower input costs, and supportive policy environment from the government. 8 core industries output fell by 1.8% in August on a high base. Excess rainfall also dampened the production in certain sectors such as electricity, coal, and cement in August. The Purchasing Managers Index, that is PMI for manufacturing, at 56.5 for September remained elevated. The services sector continues to grow at a strong pace. PMI services at 57.7 in September indicates robust expansion. On the demand side, rural demand is trending upwards while urban demand continues to hold firm. Government